Hello, and welcome to this panel session on the changing landscape of tax valuations, in which we are to focus on the implications of the proposed removal of the Post Transaction Valuation Check concession, also known as PTVC. This has been a mainstay of tax and tax valuation planning and strategy with respect to the implementation of management incentive plans. So Thomas, before we get started, can we provide us an overview of the PTVC and how it sat within the tax planning arena?
Sure. Well, before we go into PTVC, it's worth taking a step back. Whenever a manager acquires equity for a less than market value, there will be a tax charge. Depending on the circumstance, that may also give rise to a group liability to operate payroll and employers' NIC. So tax valuations are very important to underpin that market value and determine whether there's a tax charge or not. So the PTVC, as the name suggests, after the transaction or after the issuance of shares, taxpayers could approach HMRC and agree the valuation on that issue of shares or securities. So it actually provided comfort for both the company perspective and for the individuals.
Okay. So Charles, if this was such a mainstay of tax planning, why now has this been removed by HMRC?
I think it's worth pointing out that in the context of income tax, the PTVC has always been a concessionary arrangement offered by HMRC, unlike for certain other taxes. Mm-hmm. And also looking sort of internationally, it was actually fairly unique in that there aren't any other jurisdictions that kind of offer an equivalent service. Yep. I think as a practical matter, like in many other government departments, HMRC has been subject to budget and resource constraints. And simply in this context, historically they've been looking at over 20,000 valuations a year in this context. And that simply wasn't sustainable with the existing resources. Okay.
So where do you think they will be now focusing their resources in the absence of the PTVC?
Well, clearly this frees up resource to look at other areas. And whilst I think you can't second guess how HMRC will approach it, I think it would be reasonable to think that they will probably have a more proactive valuation audit strategy going forward in this area. You might expect that will perhaps be focused on the larger and more complex employee valuations where there's perhaps more potential tax at stake. Perhaps some of the more unusual ones like zero valuations, which may well be more obvious given the electronic reporting. And also perhaps at the stage where people are actually selling the shares, where they see larger capital gains, that may well trigger an investigation at that point.
Okay. And do you foresee any other implications?
Clearly it frees up resource to look at other areas, probably in the existing employee share valuation space. There are still certain schemes that you can look for pre-approval. Mm-hmm. Probably I'd say the employee shareholder status scheme may be one that gets relatively more attention going forward. Yep. Probably particularly in the context of more complex shares like hurdle shares.
Yeah, okay, excellent, thank you. And so in the absence of PTVC, Sharon, the uncertainty will persist. Where now will tax valuations be picked up and what are the implications for you in respect of any changes in valuations?
Sure, so taking an example where PAYE would apply to share issues, I think the key areas where HMRC could pick up the undervalue would be personal tax returns, corporate tax reporting, monthly PAYE reporting by the company, and also, as Charles said, the online digital versions of Form 42. Yeah. So all four of those avenues HMRC could look at. Okay. I think what's clear is that there's a need for sort of robust valuations, and also any later tax charges can also impact management as a team. So just management incentivization. Nobody wants to be stung by a big tax hit later on in the life cycle of the deal.
Okay. So how do you future-proof then against that potential tax audit and change in valuations?
Sure. So I think robust contemporaneous valuations has got to be key. So actually taking a proper look at valuations at the time the shares are issued, and getting comfortable as certain as you can from an internal perspective that valuation is really robust to challenges going forward.
Yeah. And Thomas, any broader commercial implications?
Yeah, I'd echo some of Sharon's comments that real need for contemporaneous valuations. When you're buying or selling a business, there'll be multiple advisors involved. They'll be all over the detail. Valuation will come up at some stage. So it's better to, from my experience, have dealt with the valuation at the time of share-based transactions with management rather than in the heat of battle, in the heat of the transaction.
Thank you for those insights and perspectives. To conclude then, we've heard that PTVC was always a concession that allowed for certainty of valuation to be sought. We've heard from the team here that its removal could therefore result in different behaviours in this space to address for this fundamental change in valuation risk. Quite a big change then. Thank you.